And now for something completely different.
Forget everything you've been told by others before.
Will the UA leaving OPEC break up OPEC
yeah.
plus, right? So it's OPEC plus.
Get ready for the real deal.
It's kind of like LGBTQ plus, right?
The full story.
When we run out of initials, we just stick another plus on there.
Or Euro versus a Eurozone.
Yeah, Euro plus. That'll be next.
The whole enchilada.
The Fed should be...
It's money, news, and information you can use.
The Fed should be seen and not heard, if you know what I'm saying. So.
To grow financially healthy, wealthy, and wise.
Well, when you're talking about naked trading, essentially you're going out and you're taking a lot of risk.
Now, welcome in the real deal.
Well, no, I'm talking about naked trading. I'm talking about being naked trading, right?
Yeah.
So, yeah.
The Real Investment Show with Lance Roberts.
I'm sure there's risk with that as well.
Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Monday as we start a very shortened holiday trading week. That's right, this weekend, of course, is the 250th birthday of America. So July 4th is on Saturday, which means that Friday is a holiday for the markets. So the markets will be closed on Friday. They also close half a day early on Thursday. So so it's going to be a very light trading week, very short indeed. And of course, on today and tomorrow is the end of the second quarter. Wednesday will start the beginning of the July trading quarter, which tends to be a whole lot better. So July the 1st is the beginning of the third quarter, and July tends to be a much stronger trading month. So hopefully we can kind of get past this next couple of days intact, and then get into a better month. And again, the month of June has played out pretty much close to historical norms. Kind of a strong start to the beginning of the month and then faded into the end of the month. And as we talked about last week, we were coming back down. The markets actually traded lower all 5 days last week. So it was just a week of that kind of a sell-off in the markets, not surprising. Again, most of that selling pressure came from the technology sector in general, both really kind of across the board, semiconductors included, had a pretty big sell-off on Friday. And that's just that quarter-end rebalancing. We kind of warned about that going into the end of the month, saying, hey, look, there's a lot of these hedge funds, mutual funds, pension funds, et cetera, that have balanced allocations. They are way overweight in equities, particularly in semiconductors after this massive run. So we could see a bit of rebalancing. That's what we saw. There could be a little bit more of that today and tomorrow, so don't be surprised if we see a little bit of volatility in the markets over the next 48 hours. But that should end by tomorrow afternoon. And then again, on July the 1st, all the managers are going to start repositioning once they get all their allocations realigned, right? So everything's rebalanced, and then they can reallocate cash back to the hot sectors or wherever they're trying to get into on July the 1st. So we could see a pretty strong start to the beginning of the month. Again, particularly with it being a short trading week, a lot of traders are going to be gone. That's going to increase volatility. That'll decrease volume. So again, we could see a bit of pickup this week. So just kind of navigate this accordingly. And we've also got some economic data out this week. Because Friday's a holiday, we're going to pull the employment report back to Thursday. We've got PCE this week. So there's a good bit of economic data that's going to be weighing on the market as well. Again, maybe a bit early yet to see this drop in energy prices feed through into some of these economic reports. But if something comes in a little bit hot, like PCE comes in hotter than expected, market's likely to look through that a bit because of the recent decline in energy prices. Over the weekend, there was a bit of tit for tat between Iran and the U.S. That seems to have calmed down here last night. So markets have kind of stabilized a bit this morning. Dow's looking to be up about 400 points this morning-ish. And importantly, Google, Alphabet, is now joining the Dow Jones Industrial Average. So we are now gradually moving the Mag 7 into the Dow Jones. So Microsoft's there, Apple's there, Google joining the crowd today. That's going to begin trading today with Google in the Dow Jones, and that's kicking Verizon out of the Dow Jones. So we are now moving into the Dow Jones Technology Index rather than the Dow Jones Industrial Average. But Verizon's been a long-time laggard, and again, the Dow Jones is a price-weighted index. It is not market cap-weighted, so the very high price of Google compared to Verizon is going to shift the balance of that index a bit and may also increase its kind of participation in the overall market. So again, that'll be an interesting switch. Historically speaking, when a company gets kicked out of an index, it tends to perform better, and the company getting included in the index tends to perform worse. We'll see if that tends to be the case. We're long both stocks, so we'll see what happens as this occurs here over the next trading day. So outside of that, let's get to what you need to know before the markets this morning. So as I noted, the markets did break down below the 50-day moving average on Friday. Hold on a second, don't get all excited over that just yet or panicking. Markets are getting a bit oversold here. So what's important is whether or not this break of the 50-day moving average holds through Thursday. If the market recovers over the next 24, 48 hours, this break will just be a short-term break, and that's it. Be careful making any kind of major moves in your portfolio because of these breaks. We've seen these breaks before. They resolve very quickly. Again, there was some forces within the markets leading to that sell-off last week, particularly on Friday. That was that quarter-end rebalancing. And again, like I said, you got quarter three starting on Wednesday, so we may very well see a push back above that 50-day moving average. So don't make any knee-jerk reaction. My point is, be careful with moving averages. We talked about this before. It's a very important level to look at. Don't discount the break of the 50-day moving average, right? It is important. We did break an important moving average for the markets. There is support down around 7,040-ish on the S&P, so which is the 100-day moving average. But that break of the 50, again, there's some kind of stuff at work behind the scenes driving that sell-off. Again, as we noted, it was kind of quarter-end rebalancing. We're working through that right now. But we've seen these breaks before that immediately recover. So again, if you kind of make a knee-jerk reaction, like, oh my gosh, I broke the 50-day, got to get out of the markets. Sometimes you get this kind of reflexive action. This is why a lot of people say, oh, stops don't work, this doesn't work. Because generally by the time that you get to a point of breaking a moving average or breaking a stop level of some sort, the markets or the equity, whatever position you're talking about, has gotten pretty oversold. So a reflexive bounce from these levels is not surprising. What happens following that reflexive bounce is going to be important. If there a rally back to the 50-day moving average that fails, turns back lower, takes out today's low, that is a signal to start reducing more risk rather rapidly in your portfolio. But again, if it rallies back up, gets above the 50-day moving average, there's nothing to worry about. You kind of stay there. So again, kind of watch. It's not the break that's important. It's what happens following the break that is most important to how you position and manage risk within your portfolio. But keeping a watch on that here real quick, the other side of this is, as we talked about on Friday, is semiconductors. Of course, they've been under a lot of pressure here over the last few days. Again, we've taken out the 20-day moving average. The break. This is the semiconductor ETF, right? SMH. So we saw that peak, has been selling off, broke below the 20-day moving average. There is risk down to about 566 on SMH. So again, there is some downside pressure, particularly the semis. You're on a sell signal and you're not oversold here. So there is some more downside risk here temporarily over the next couple of days as we go through kind of rebalancing. We'll see what happens. Again, this break of the 20-day, we saw that right here. This is what I'm talking about. You see this break of the 20-day moving average that immediately recovered back above it, broke it again, then recovered back of it, and then the market took off. That's why I'm saying be careful of these moving averages. Sometimes they tend to be head fakes. Watch what happens after the fact of that break. Does it recover immediately or does it break down? But watch semiconductors, 18% of the market cap right now. So what happens with them over the next couple of days as we wrap up quarter-end rebalancing is going to be important. Again, I think everything's going to be fine here. There's still a lot of momentum in that sector. The overall narrative about chip supply shortage, et cetera, that still remains very much intact. But just trade that with a little bit of caution. These are very extended from long-term means. There is risk of a bigger correction at some point this summer. So again, just kind of manage your risk accordingly. All right, that's what you need to know before the bell this morning. We'll come back. We're going to talk a little bit about where's all the money coming from that's coming into the markets and Milton Friedman. We're going to start with Milton Friedman when we come back. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
When there's rumors going round, how the market's going down, who you gonna call?
Narrative Busters.
When you're worried about your dough, in the markets ebb and flow, who you gonna call?
Narrative Busters.
Our next Candid Coffee pits Lance Roberts, Richard Rosso, and Danny Ratliff against all the false talk you're hearing these days, and how market narratives are created and spread, and why emotional investing can derail your financial goals. Saturday, July 18th, it's the Narrative Busters edition of Candid Coffee with Ratliff, Rosso, and Roberts. Register today at realinvestmentadvice.com.
When perspective's dim, don't invest on a whim. Who you gonna call?
Narrative Busters.
Candid Coffee, Saturday, July 18th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
I don't think you're going to win a SAG award for that. That Candid Coffee commercial. How close can you get to copyright infringement? Pretty good. I'm not sure that Google's going to flag that one in particular. They're going to say that one's so bad we're just going to let that one fly.
We went round and round and round.
I am sure you did. All right. Welcome to the show this morning. Always fun to be back here in the studio on a Monday. Never know what's going to pop up over the weekend when Brent's done a little bit of this, you know what I'm saying? So that's all we're talking about here. Anyway, good morning. So how many of y'all have heard the line that says inflation is always and everywhere a monetary phenomenon? Y'all can just put a 1 in chat if y'all have heard of that before. I'm sure you have, because most of y'all quote it to me most of the time when we're on the show. Whenever we're talking about inflation, kind of the immediate push is to go, well, look at M2, look at the debt, etc. And that's why, Milton Friedman said that inflation is always and everywhere a monetary phenomenon. And again, it does make some sense. And economists and markets and investors have relied on this quote to a large degree to back a narrative, whatever they're talking about. And again, I'm seeing some ones pop up here in the chat this morning. Not surprising you've heard this saying, because it's kind of around everywhere. How many of y'all, and so now here's the next question. How many of you believe that inflation is always and everywhere a monetary phenomenon? Right? So you've heard this. How many of you believe that to actually be the case? So, and it's important because this frames a lot of what is happening within the markets. It frames a lot of what's happening in the economy. And it frames a lot of the narratives behind certain asset classes, behind certain themes, behind certain motivations from individuals that are trying to sell you a product, good, or service. But it's important to understand what this all actually means. Now, here's the very, very important part of the conversation this morning. Brent, can you bring up that quote for me? This is the actual quote from Milton Friedman. Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. Now, the last half of that sentence is the most important part, and particularly the last 4 words, than in output. And the reason that this is so incredibly important to understand is that it explains a lot of things that have happened in the economy. It explains a lot of things that's happened with inflation, and why, since 1980, the economic growth rate has continued to decline along with inflationary pressures because of the increase in the debt and the deficits. And again, so if you take a look at, for example, 2010 through 2000 and, well, today, right? but particularly 2010 to 2020, before we started sending checks to households, those type of things, we had no inflation. In fact, the Fed was begging for 2% inflation, but we were increasing debt sharply. We went from $9 trillion in debt underneath Barack Obama to $18 trillion in debt under Trump's first term. And then we've grown that since then, and now we're approaching $40 trillion, and yet the economy is still percolating along at about 2.1%, 2.2%, not the 6, 7, 8% growth that we were getting back in the 60s and 70s. Why are we not growing at that rate any longer? And a lot of that has to do with the debt. And why is the debt important in the fact that we are not getting inflationary pressures from the debt? Because again, we were told by all the media that inflation is always and everywhere a monetary phenomenon, but yet we're not getting inflation. The only time we've gotten inflation is when we did what? Shut down the economy and sent checks to households, where you created a supply-demand imbalance within the economy. But the last statement, the last 4 words of Milton Friedman's quote, "Inflation is always and everywhere a monetary phenomenon," is when it reflects what happens with output. And this is one of the things that's going on today that is important to understand as well, that we are getting some economic push and we are getting some economic inflation from the CapEx spending that's being done by all the hyperscalers. That's being reflected in economic growth today. We are seeing that. The latest GDP report and the revision of the GDP report was the most telling, because personal consumption expenditures, which makes up about 70% of GDP, was almost non-existent. But we had a 2.1% economic growth rate, real, in the second quarter, and that was due, and that's also annualized, by the way. That 2.1% growth rate was almost entirely made up of business CapEx spending, business investment. Strip that out. If we didn't have that hyperscaler spending right now, if we strip that out of that GDP report, we were barely positive. So if inflation and economic growth, which is what drives economic growth is what drives inflation. So if economic growth and inflation are basically zero, why is that not being reflected by the size of the debt, right? This is the big concern. And it's because the debt that is being used is non-productive. It is not creating output. So if you go back to that statement, inflation is always and everywhere a monetary phenomenon, in the sense that it is and only can be produced by an increase in the quantity of money more than output. In other words, the quantity of money has to grow faster than the rate of output to create inflation from a monetary base, and that's not what's happening. Actually, M2 growth has been very flat here for the last couple quarters. But it's the more than output that is the most important thing, because of most of the debt that we use, where do we send it? Almost all the revenues that are absorbed by the tax dollar in the U.S. goes to Social Security, Medicare, Medicaid, veterans benefits, those type of things. Now, that money winds up back in the economy, don't get me wrong, because all that money, Social Security checks, veterans benefits, all that winds up in the pockets of households, which do spend it in the economy, but it's a one-time flow through. And today, because most of the economy is services, about 80% of the economy is services versus 20% manufacturing, that has a very low multiplier effect. In other words, the turnover of that money is very small. Versus economic spending, or manufacturing spending, that has a much higher multiplier. So the same dollar, so if I spend $1 on services, that has a turnover of about $1 for $1. It's very small. When I spend money on manufacturing, that's about a $4 to $5 multiplier. So I'm getting $4 to $5 of economic activity versus every dollar spent in the economy. And this is why that small sliver of that 15% of GDP that's driven by business investments having such an outsized impact on the economic growth rate right now, because of that multiplier effect. I'm spending money building a data center, but when I spend that money on that data center, It requires building roads and bridges and building out power supply. And then, of course, all the materials, the commodities that are needed to build that data center. And then I've got to create all the jobs of the people that are building that data center, which then they go spend money around that area where they're building the data center. So people build, and this is happening right now, we're seeing around these data centers, we're seeing a lot of businesses being popped up, apartment complexes and restaurants and these type of things to support the data center. There's a lot of activity. And of course, where they build a data center, they're going to start building neighborhoods, et cetera, around that data center. And then you're going to start, creating more economic activity. But that's that flow through that happens when we spend money within the overall economy. But when we spend most of that on non-productive investment, that multiplier effect is almost nil. This is why when you go back to the 60s and the 70s, why did we have such strong rates of economic growth? So this is a chart of the 1970s, and this is CPI versus M2 growth, and then of course we had some oil shocks in there along the way, and we saw this happening a couple of times, right? So CPI was growing through the 1960s and 1970s. We had some oil shocks that came along that popped up inflation, but then inflation would quickly resolve itself after the decline of the oil shock. But the trend of inflation was higher. Why was the trend of inflation higher? Because we were running 6, 7, 8% rates of economic growth that were growing in the 60s and 70s because we were manufacturing and producing. We were in the middle of the space race, and we were fighting the war in Vietnam, and we were just producing all kinds of stuff. 80% of the economy was manufacturing, so most of the debt that was being used to finance, and most of the money that was being sent through the economy was on the manufacturing side of the ledger. So yes, we had inflationary pressure. And this is a mistake that's being made today. A lot of people are like looking back at the 70s and going, we're about to have a repeat of the 70s and inflation about to go spiking off to the moon. The answer is no, you're not, because you don't have the oil crisis. You have more supply than demand, and we're mostly services driven, not manufacturing. So the flow through has a much smaller impact than we did back in the 70s. You can take this down. And so it's that last part talking about monetary inflation coming from the use of dollars creating more output. That's the most important aspect. Now, again, money supply is growing. There's no doubt about that. And as we've talked about before, how do we create money? We create money by lending it into the economy. There's no printing press. There's nobody out there, with a little printer, kind of printing out dollar bills. If you do that, it's called counterfeiting. You go to jail for that. So how do we create money in the economy? We loan it, right? The government issues debt to fund its revenue needs, or revenue shortfalls, I should say. So whatever money they need in excess of tax collection revenue that they get, they issue debt. The banks, the primary dealers, buy that debt, which increases reserve balances that they can now lend against that. The Federal Reserve increases reserve balances by taking some of those bonds off the bank's hands. They hold that on their balance sheet. They increase the bank's reserves. There's no money created in that transaction. That's an asset swap. But the reserves are what banks use, because we're in a fractional reserve banking system. They use those reserves to make loans. When they make loans, that's what creates money in the economy. So think about it this way. Brent loans me $1, right? Brent says, yeah, I'll loan you. It's the Bank of Brent. So I give Brent, $1 in deposits. So he's got $1 in deposits. Now he can loan out $10 because of fractional reserve banking. So somebody else comes to him, his daughter comes to him and says, hey, I need a loan, Pops. And Brent says, okay, here's $1. And then his son comes to him and says, here, I need a loan. He says, okay, here's $2. So he can loan out $10 on that $1. So he's taken $1 and he's created $9 additional dollars in the economy that people are spending. So they go out and they spend that money. That's how money's created. It's created through lending. Nobody's printing money. When somebody says there's a printing press somewhere, they don't have any idea what they're talking about. So just disregard that. but we loan money into existence. But now this is the most important part, right? Everybody says, well, look at, and they incorrectly show you a chart of M2, which, M2 is rising and it's going up. And they say, look at M2, right? This is why there's going to be massive inflation because of M2. No. M2 has to grow faster than economic output, which only happened and has only happened during the 2020 pandemic when we were just literally loaning money like crazy. We issued out trillions of dollars of debt from the government into the economy, sent checks to households, created a supply-demand imbalance, and money supply grew faster than economic growth, and that's why you had 9% inflation. Since then, that money supply growth has dropped off sharply, and we're now back below where we were. Now, this brings up a very important part that we've got to get into here in just a second, which is about monetary velocity. But money has to grow. If the money supply doesn't grow, you have no economic growth. So while everybody looks at money supply and they go, oh, look at M2, it's going up. If you had no growth in the money supply, you would have no economic growth because there would be no money flowing into the economy. But this brings up the most important part of this entire conversation, which is the identity of money. And importantly, money supply and monetary velocity. There's an equation. This is the most important part of this entire conversation. And if you walk away with nothing from this conversation today, if you still want to believe that money is always and everywhere a monetary phenomenon and that's all you want to hear, I can't help you. But understand this one part about monetary velocity. And think about it this way. So monetary velocity, the formula for that is MV equals PQ, which there are 4 variables to that, not 3. And the V is the most important part of that equation. You can't just look at M2. You have to look at the velocity of M2, which is how money circulates through the economy. Think about it this way. The government prints $1 trillion right now, this second, gives it to Brent. No. 2 trillion. Because he's got to have more money than Elon Musk. So we give Brent $2 trillion. So the government prints $2 trillion in debt just for Brent. Sends $2 trillion to Brent's household in his bank account. He never spends a penny. He doesn't invest it. It's sitting in 0% money market funds. So he's getting no interest income on the money. It just sits there. $2 trillion. Oh, and the debt was 0 coupon, right? So there's no interest on the debt. This is just pure creation of money, right? So so $2 trillion have been issued. It's sitting in Brent's bank account. Nothing's happening with it. Nothing's happening. What is the impact on inflation? What's the impact on economic growth? Oh, wait. Y'all figured it out yet? Yeah, there's no inflation, there's no economic growth. Why? Because the money did nothing. Now, conversely, the government issues Brent $2 trillion and he goes out and buys Elon Musk's company. He buys SpaceX, right? With his $2 trillion. That really doesn't do a lot for the economy, right? That's a financial transaction. Nothing really happened. Nothing moved the needle much. Different story. Conversely, Brent goes out and he says, you know what? I'm going to solve America's housing problem. I'm going to build 5 million houses. I don't know how many houses you could build with $2 trillion. It's a lot.
Depends on the size.
Yeah. I haven't done the math, but Brent's going to go build 5 million homes, 10 million homes. Pick a number, whatever the number is with that $2 trillion. So he goes out and he hires the best architects, the best engineers. He hires the best construction companies. He goes out, cuts deals with all the major suppliers of lumber and sheetrock and nails and carpet companies and furniture companies. So these are all going to be fully furnished homes when he does it, because he's going to solve the housing crisis. He builds these 5 million homes. That creates velocity in the economy. That $2 trillion of economic activity, and by the way, it all happens within a week. He does this all in a week. He's magic. You're going to have a massive surge in economic growth, and you're going to have a massive flow through in inflation because of all this push into the economy of economic activity. Velocity is the most important part. Sending money to households that turned around and spent money into the economy created a surge in velocity. That's why you had inflation. That velocity is now going away. Issuing debt to fund Social Security that creates a very low multiplier in the economy. The reason you don't get inflation from that has very low velocity. So that velocity is the most important part of increases in monetary supply. So if you're worried about increases in monetary supply, talk about velocity, measure velocity, watch velocity. And the velocity of M2 is available on Fred. You can track it yourself. Here's a chart of monetary velocity since 2000. And you can see that post 2020, we had velocity has been declining in the economy since 2000. And that's why we've had no economic growth, no inflation. You can see the uptick in velocity following the 2020 pandemic, where you saw the uptick in monetary supply. That did translate into some velocity. That's why you had inflation. That's now starting to level out and flatten, along with monetary supply. So if velocity starts to flatten out and turn back lower, you're not going to get the flow through from inflation because you're not getting the transmission system into the economy. Thank you, Brent. That you need to create higher forms of inflation. So this really brings us down to the final point of this, which is that the composition of credit is the most important factor. Now, by the way, if you want to really learn more about all this, the entire article is on the website. I posted it up on Friday. It's called Milton Friedman Was Right, just mostly misquoted. It's on Friday. All the relative data, charts, sources, all that is there for you if you really want to dig into this and get a little bit more kind of information, understand it. But a dollar, as I said, it's the composition of the credit that's the most important facet of this. Again, a dollar lent to build a factory is much more important than a dollar that's lent to pay Social Security. They both wind up in the pockets of households somewhere, mind you. But the quality of that spending is much more important. So so the same dollar. So let me give you a good example. A dollar lent, and this is actually, I'm going to read to you this from the article. A dollar lent to build a factory expands future productive capacity, but a dollar lent to fund a stock buyback inflates current asset prices without expanding the economy's productive capacity. A dollar lent to a consumer for a vacation expands current consumption without leaving any productive residue. Here's the key of that sentence. Same dollar, same monetary creation, very different downstream effects. So when you talk about debt, and if you're worried about the debt creation, that's fine, and you should be. But not from the inflationary standpoint. The more debt that you create that has a non-productive benefit to it, the slower the rate of economic growth you're going to get, the more stress you're going to have economically, the lower rates of inflation you're going to have, which you need inflation. Inflation, if you want to have economic growth, expanding wages, those type of things, you need inflation. So while we're all walking around going, hey, we need lower inflation, we need lower inflation to a point where inflation is not impeding economic growth, but you don't want no inflation, and particularly you don't want deflation because that erodes economic activity. So that's why the Fed kind of targets that 2% growth rate, because 2% growth rate gets you about 2% economic growth, which absorbs employment growth within the economy. 3% inflation's not bad if you have economic activity going along with it. So again, it's the quality of the credit that's being issued, and it's the composition that's the most important. And again, that's, we want growth, but we want productive growth. Productive growth will increase the rate of inflation, but it also creates wage growth, which I've got an article coming out for you in the next week or so, talking about wages and how important they are to the overall economy. A lot of it makes sense to you and should. But I put a chart in here for you so you can kind of see this. But the difference between productive credit, which is factory construction, data centers, chip fabrication, power infrastructure, capital, that's what's happening right now. And that's why we're seeing economic growth doing better right now because of that. If we have if all the money that's being spent in the economy is going to stock buybacks, asset speculation, real estate flips, margin lending, M&A leverage, balance sheet engineering, that forms bubbles, keeps inflation muted because you're not getting a push through into the economy. And of course, the reversal risk of all that builds. And that's where you get market crashes, those type of things. Consumer credit, credit card spending, auto loans, stimulus transfers, vacation borrowing, personal loans, buy now, pay later. That lifts consumer consumption. There is a pressure direct on that, but the quantity of money doesn't change. So, again, keeping this all in mind, right, is very important. And again, it's worth a conversation. It's worth kind of understanding this a bit more because there's so many people talking about Milton Friedman's first half of his quote, and they don't take into account the most important part of that quote, which is than in output. So again, I hope that helps a little bit because again, we have this conversation often, but again, I see so much of this in the media and from relatively intelligent guys that just quote the first half of the conversation. They're absolutely convinced that money, and they post out charts of M2 money supply, and they go, this is why, this is going to happen. This is why, X is going to happen or Y is going to happen. That's why we're going to repeat the 70s. Very different environments from the 70s that we have today. The composition of credit is very different. The quality of the credit is extremely different. The spending of the credit is very different. And those all have very important impacts on the outlooks for economic growth, inflation, asset growth, and most importantly, your personal outlooks on your investments and kind of how you're allocating money. And that's why we go through this stuff, is to make sure that we have a very good handle on how we're investing and make sure that we're investing against the right narratives and that we're investing against the right facts and figures and not, something that you read somewhere or heard somewhere from some person, and then you make an investment decision that impairs your outcome because you're investing in the wrong asset class at the wrong time. But speaking of investing, let's move to a different topic here real quick, which is, I've got a few minutes left, is where's all the money coming from? It has been absolutely amazing this year so far about the amount of money that has been flowing into the markets. In the first kind of 6 months of the year right now so far, let me see if I've got a chart on this real quick. No, I don't yet. In the first 6 months of this year, we have seen, not yet, Brent, we have seen record inflows into ETFs and equities. We have seen flow. I think I actually may have a chart on this. Let me see if I can find this chart here real quick. We've seen record inflows into assets across the board. It's been, and it's really been quite phenomenal. I mean, like I've seen, periods where we've had massive surges in, ETF flows, et cetera, before, but nothing to the quality or really to the quantity that, here we go, that we've seen here just as of late. This is U.S. listed ETFs, flows by calendar year. By calendar year, okay? 21, 22, 23, 24, 25 was a huge year. 24 was a huge year. 2026, we've already gotten to $1 trillion. Last year was a record. We were about $1.5 trillion last year in ETF flows. Pretty huge. We're over $1 trillion right now, and we're 6 months into the year. So it has just been quite phenomenal about where we're going. This is levered. So this next chart is levered and inverse ETF cumulative flows into the market. Again, when you take a look at entire years versus the first 6 months of this year, you can see the pace that we're growing at. So, and so this really kind of brought me to the question of where's all the money coming from? I mean, it's you hear about, the American can't raise $1,000 and, if they had an emergency, they can't come up with anything. And of course, it's just been this. And this is, and there's a little bit of misnomer to that because there is a group of the economy that is financially strapped. But that's not everybody. This is household cash as a percent of total financial assets, which is at a record right now, about 8%. And what you'll notice is that cash increase started in 2020 when we sent checks to households. And that's been accumulating ever since. Which, again, this chart shocked me because I would have assumed that we would have spent most of that money, but we didn't. And if we take a look at the narrative, and again, we take a look at this narrative that households can't make ends meet, this is a true narrative, right? There was an article out just recently. It says, the numbers behind the anger are not made up. Bankrate's 2026 survey found that only 47% of Americans have enough liquidity to cover a $1,000 emergency, and 1/3 would go into debt to handle it. You can bring up this chart for me. A separate U.S. news survey put it bluntly, more than 2 in 5 couldn't pay a $1,000 surprise expense from savings, and median emergency fund fell to $5,000, half of what it was a year earlier. Prices are up 26% at the end of 2019. Wages are at the low end, haven't kept pace. Make no mistake, the bottom of the K is real. And this is how Americans, according to the surveys, would handle a $1,000 emergency: go into debt, pay from savings, cut spending, use regular income. So, that's not a wrong narrative. It's very much the case. But when we take a look at households, things are getting actually better. They're not getting worse. And we kind of wrote about this recently. There was an article we just published, I think last Friday, talking about the K-shaped economy. And one of the important factors is that when you take a look at the K-shaped economy, the K is actually improving. And here's a chart of the composition. This is U.S. households by total money. Income is constant in $2022. But high income earners, $100,000 or more, they've actually increased. Middle income between $35,000 and $100,000, those have actually decreased since 1970. So in other words, the middle income individuals, $35,000 to $100,000 in 2022 dollars in 1970 made up about 54.6% of the economy. Today it's 39.1. Lower income, $35,000 or less, went from 32 to 23. High income earners went from 13% to 37.5%. So in other words, we've moved more people up the ladder since 1970. We've expanded wealth on an inflation-adjusted basis. We've expanded wealth across the K since 1970. So in other words, things are getting better financially. And this partly explains why, when you look at household asset cash as a percentage of total assets, that number has increased and is remaining there, because the market increase over the last 5 years, which has been quite phenomenal, 15% a year, is feeding into households through 401k plans and investment accounts, those type of things. Of course, we've made investing much more mainstream these days, so more and more people are getting involved. This is a good thing. There's a good thing and a bad thing to this, right? We're getting a lot more people involved in the financial markets, and we're getting them involved sooner. And that was part of that article in the K-shaped economy. If you take a look at Gen Zers, more of them are now invested in the markets and financially improving their wealth than either the boomers, the Gen Xers, or millennials. They're ahead of the game. So that's a good thing. The bad thing is they're all speculating in the markets on wild, crazy bets that are probably going to wind up hurting them, but that's a different story. But if we get down to again, the question though is that's just retail, right? So there's more money coming in, and it's coming in from everywhere in the world. I mean, we're seeing retail money market balances that are hitting a record right now. So again, we know that retail has some money. They're certainly investing that into the markets. Retail money market fund balances from 2021 were about 1.45 trillion. They're about 3 trillion today. So retail investors are accumulating more cash. But that doesn't account for this massive insurge into ETFs, et cetera, that we're seeing in the markets currently. That's coming from international. We're seeing record levels of foreign inflows into U.S. assets right now. That's why the dollar's been on a big tear here as of recently, because when they invest into the U.S., that increases the strength of the U.S. dollar. So we're seeing a lot of money flows into that. When you take a look at retail investors, as a good example, equity ownership since 2010 in terms of retail has grown remarkably. The bottom 50% of the economy. So now we go back to the K-shaped economy. Oh, the poor people, they're completely losing out on the markets, et cetera. Their equity ownership since 2010 has increased by 571%. Now, this is a little bit of a misnomer, right? They're still a very small fraction. They're about 3% of total equity ownership is the bottom 50%. They don't own a lot, but it's increasing, right? It's improving. More of them are getting involved in the markets, and that's helping increase this kind of support for the overall market. The top 1% has grown by 436%. The next 9% is up 408%. The next 40% is up 331%. So equity ownership since 2010 has increased sharply across the markets. That's been because of low interest rates, the ability to borrow on margin. Again, I've got an article coming out next Monday on margin debt that we'll discuss here on the show, because there's a lot of charts running around on margin debt that are really not good indicators of margin. But we'll kind of go through the margin debt. But margin debt's at an all-time record. So investors are borrowing more money. That's fueling the bull market. That's increasing inflows into the market. You get more and more individuals across the country involved in the markets. That's creating more inflows into the markets. You have increased flows of foreign investment into the U.S. That's pushing the markets. So again, we're just seeing this overwhelming support of financial market through money flows. And again, when money's flowing into the markets from all these different areas, markets are going to go up, right? Markets, just like everything else, is a supply-demand game, and you're just seeing this massive amount of flow into the markets that are kind of this head scratcher at the moment. It's like, where's all this money coming from? But it is, and we need to pay attention to those flows, because those flows are very important to this. So I mean, in other words, my point is if you're betting on an immediate market crash, it may be a while. And what I mean by that, it doesn't mean that the markets won't eventually crash. It doesn't mean that you won't eventually have a big correction. You can even have a big correction even with all this going on. You just need some event to crop up that kind of makes investors reevaluate markets. But with the amount of money being pushed into the markets on a daily basis, a weekly basis, a monthly basis, reinvesting of markets, 401k plans, all these type of things. And again, piling into ETFs that then have to go out and buy the underlying securities, that flow through, that increase of passive investing that's now, just become a monster within the markets, is driving asset prices higher. And that certainly leads to and again, reasonable expectations like, oh my gosh, we're in a bubble. This is eventually going to pop. Yes, probably true. But just like we saw in 1997, it can last a while before you actually get to that. And that's why predicting bubbles is very difficult. They're only really visible in hindsight, because when it eventually pops, it'll be due to some event that occurs that we're not currently expecting that breaks that flow of money into the markets, breaks that speculative attitude. And again, with so many people now investing in leveraged ETFs, and they're going on margin to buy leverage to further increase their gains, that can last for a while. That momentum, that psychology is very difficult to break. So again, if we take a look at kind of the American retail investor, that, we take a look at this part where it's like, everybody's getting left behind. It's terrible. And it's not really the case. Here's a kind of a table I put together. You take a look at the household balance sheet and what it says. 47%. So this is from the surveys, right? 47% can't cover a $1,000 emergency from savings. There's $7.9 trillion sitting in money market funds. Now, a lot of that's corporate cash. So again, we just showed you that only about $3 trillion of that's retail. The rest of that's corporate cash. But there's a lot of cash sitting out there. Median emergency fund fell to $5,000. That's half of last year. ETF flows are tracking the strongest year ever, past $1 trillion by mid-June. 1/3 could borrow money to handle a surprise bill. Bottom 50% equity holdings are up $617 billion. That's 571% since 2010. 54% say inflation is forcing them to save less. Record $926 billion in year-to-date buyback authorizations, 42% from techs, which are not inflationary, by the way, as we talked about with Milton Friedman a moment ago. So 2 different households, one being surveyed to spin a narrative. The other is what the brokerage statement says. What you choose to listen to determines your outcome in the financial markets with your investing. Thanks, Brent. And what I mean by that is this goes back to, and this is our candy coffee that's coming up July the 18th, a couple of Saturdays from now. And certainly encourage you to go register online. Love to have you there. It's going to be, we're going to take questions, all kinds of stuff. It'll be a good time. But these narratives, right? That's what gets us in trouble financially. And when we have the flows that we have coming into the markets, and particularly when they start piling into certain areas, can you bring up these bullet points for me, Brent? When they start piling into certain areas of the markets, semiconductors, you can have these outsized moves. So what do you do about all this? Pay less attention to the surveys that are driven by a political agenda mostly. Some of this is, some of it's not, but there's a lot of political bias to this. We want to make the president and the administration look bad, so we're going to post this article, take this survey. We're going to slant the survey in a certain direction. Happens all the time. Just spin a narrative. My point is just be careful of the surveys. A lot of them times they have biases. A lot of times they're sampling errors. There's a lot of issues with them. And that's why it's so important to get down into the data. But more importantly, are there troubles with the American households? Absolutely not arguing that point at all. There are many households that can't afford to pay bills, etc. That's important to understand. It's true. But that's the case in every economy. Doesn't matter, socialist, communistic, etc. Everybody has poor people. Everybody has rich people. There's no way to get around that. Those surveys are true. Those financial situations do exist. I'm not discounting that at all, but that doesn't have anything to do with investing in the markets, which is what we're talking about here today. So don't fight the tape. Right? Rebalancing is not market timing. So while these markets are doing what they're doing, because of these money flows, because of these extremes, because of what's happening in markets, participate with it. Just rebalance, reduce your risk, those type of things. Just the basic stuff, right? The basic gardening that we talk about. Go to our resource library, go to our ebooks, download the ebook on Real Investment Advice, which talks all about how to use gardening as a portfolio guide. Keep some of that cash as dry powder because cash gives you opportunity. When there is a correction in the market, when there is a sell-off, when something becomes cheap and oversold, time to put some of that cash to work. Kevin O'Leary got into a lot of trouble, and I addressed this in the conversation because he's talking about $28 lunches, and the average person needs $5 million in savings and T-bills to be secure. I don't necessarily agree with what Kevin O'Leary's saying, but there is some legitimacy to it. But at the same time, it's not just people spending $28 on lunch that's getting them into trouble. It's a whole lot of other things. But we can all improve our financial situation by investing soundly, investing strategically, investing with a discipline, getting that money put to work, making sure we're saving at home, reducing our expenses, paying attention to our outcomes, not living beyond our means, getting ourselves out of debt. Those are all things that we can improve to improve our lots in life and become much better financially down the road. But the money flows into the market, they're enormous. And they're coming from everywhere. Stock buybacks, foreign inflows, retail investing, it's just I've never seen anything like this in 35 years of my life of investing. I've never seen flows like we have seen just over the last 3-4 years in particular, really since 2020. It's just been, a phenomenon. How long it lasts, I have no idea. But right now, we just need to participate with the markets, understand that this money is real, understand that, it doesn't matter where it's coming from, who's investing in what, where it's going. Just understand it's getting invested and it's pushing markets. And we need to navigate that accordingly. All right, I've run way long today. I apologize. That article is that is today's article on the website. So be sure and download that as well. The one with Milton Friedman, if you want to get more into the money supply issue, that's there for you as well. Other than that, y'all have a great day. Be sure and like and subscribe to the channel. We appreciate you very much. And we will be back tomorrow with John Penn for Two Dads on Money. I'm not sure what we're going to talk about tomorrow, but I'm sure we'll come up with something between now and then. John will. John always does a good job with that. Anyway, we'll see you back here tomorrow on the next edition of The Real Investment Show. Y'all have a great day. See you.